Welcome back to the portfolio updates. Today I'll be going through the recent Netflix earnings, the new Apple savings accounts, and some of the banking news from previous reports from JPMorgan, Bank of America's recent results, and Goldman Sachs' upcoming reports. First, I wanted to start with a quick overview of how my portfolio is looking. Overall, my US portfolio is sitting around $13,476. The stock market has been going up, and now my portfolio is up over 3.17%. Going through my positions, you can see Apple's my main player in regards with total returns, how good it's done. It's up close to 24% now, but overall, if you look through, everything's pretty even once you all work it out. I'm up around $414, but yeah, I was up a lot more previously. I've been down a lot more, but things are starting to level out. In regards to my Vanguard account, this is sitting at around 5,787 Australian dollars, and not much has changed in that one, but I will be investing in tomorrow again. So currently all my positions are still the same from the last update. My positions are VHY, which is Vanguard's Australian ETF, their high yield, VLC, which is the large company tracking index, and then their VGS, which is the international shares. The first thing I wanted to go into today was actually around Netflix stock and Netflix's recent earnings. Having a look at Netflix's stock, you can see the earnings only just got released, and so not much has really happened. But in regards to the last week, the stock has traded down, but it has made a comeback this year. You see, it had a really good start around February time, but in the last month it has gone back up around that 11.5%. But if you're a Netflix investor, yeah, you can see the drop off from a year ago. I remember some people I know were investing around here, and then it's had that massive drop off, and it's been fighting to try to come back. But going through Netflix's recent results just kind of quickly, in terms of how they did their earnings per share, they beat out unexpected, barely, but in their revenue they just missed out. Going through, you could see there's a mixed results. They did pull back on the Netflix password crackdown, which was a big thing. You saw a really negative kind of sentiment around it on social media, where people were saying they'll no longer use Netflix, that type of thing. But from just a strictly business standpoint, you can understand why Netflix is doing it, because I know all my family and friends, we all use pretty much one or two Netflix accounts or subscriptions, and then people have their accounts in it, so they're probably losing out on a lot of money. So you understand exactly why senior management is making these decisions. And yeah, originally Netflix wanted to roll it out in place late in the first quarter, but Tuesday it said it would do it in the second quarter. Kind of going through the results for the earnings ended in 31st of March. Netflix reported earnings of $1.31 billion, or $2.88 a share, compared to the $1.6 billion or $3.53 a share a year earlier. So revenue grew to $8.16 billion from the $7.87 billion the year prior, and shares of Netflix initially fell 10%, but have mostly recovered in after hours trading. So that's what I was talking about. I know I saw another video from, I believe it was Joseph Carlson, put it out about kind of how he thought the negative sentiment around the earnings was unnecessary. But they did also subtract, or they did kind of step back a bit on their guidance. Going through the password side of things, the company said more than 100 million households share accounts, or about 43% of its global user base. And that is massive for Netflix, because as much as they are growing, and they're still trying to grow, it's hard to grow at the rates that it was when it was a lot smaller. Now they want to crack down on this, which would allow them to increase their revenue and eventually make shareholders their money back. Because you look at the stock, like we did a little bit earlier, investors haven't had the best time. Look at the last 3 years. It's still nowhere near even the highs of 3 years ago in 2020, when pandemic times. But the growth story of Netflix is an interesting one to look at, because a year ago, like it says here, Netflix had reported its first subscriber loss in a decade, sending its shares downward spiral, as well as those of the media peers. The results pushed Netflix and streaming rivals to focus on profits over subscriber numbers. And yeah, when you look at any earnings for any streaming services, whether it's Disney, Netflix, the usuals like your Hulu, all the other ones that are offered, the big thing they talk about is growth. But again, profit is probably the main thing, especially now with, you see the economic headwinds with all these businesses are facing in regards with generating a profit. That is where investors are looking. They are looking to make money now. They don't want to see a guidance for 5-10 years down the road, especially with rates being so high and everything like that. They want to get their money now, and growth companies were the ones that did take the hit. I mean, you look at the NASDAQ and stocks, you could see the tech market was the one that got hammered. We take a quick look at the QQQ. If I can find it, here we go. This is the best description of kind of looking through tech stocks. See that massive run up around 2020, even in 2021, and then that pullback, and it's kind of hopefully going to be going up a little bit now. Yeah, tech stock investors have not had the best time, and I know I used to be invested in the QQQ myself, so I saw this firsthand. For Netflix investors, again, most people I know who are invested in Netflix see it as a long-term play, not as kind of something in the short term. But hopefully after these economic headwinds, the company can get back to and get its shareholders back to previous prices of, 2020, 2021. The other news I wanted to touch on as well was actually around probably easily the most successful holding I have, and it's around Apple, and that is Apple's savings accounts that it's actually offering now. You would see Apple did post about it on their pages as well. Apple Card's new high yield savings account is now offering available 4.15% APY. So if you use stuff like Apple Wallet, that type of thing, yeah, they've brought this in. Mixed reaction. If you kind of go through, you can see starting today, Apple's users can choose to grow their daily cash rewards with a savings account from Goldman Sachs, which offers a high yield APY of 4.15%. That's more than 10 times the national average. No fees, no minimum deposits, no monthly balance requirements. Users can easily set up and manage their savings accounts directly from Apple Card in Wallet. This is massive, especially for younger generations. You see everyone who has an iPhone uses the Apple Wallet, has their cards linked. And from an Apple perspective, this is also huge. Especially for keeping it sticky, keeping people on your site. If people have their banking set up through an Apple, they're not going to leave to go Samsung or go to another competitor, Google Pixel. The more stuff of people you can keep in one place and the easier you can make it for them, the more you're going to get long-term customers, and that's what Apple understands, and they know they can make a fat check of money, I'm sure, from this. And yeah, there was even another report from it. You can see the release, and it is with Goldman Sachs, who they have worked together before. I think as an Apple shareholder myself, I think this is good news for the shareholder. I don't see any negative kind of situations coming out of this for Apple. They're probably the ones more on the safe. They have more than enough cash if they did need to, if they did have to pay for stuff in the future, or if they did have to, again, pay out these interest payments. But they are partnered with Goldman Sachs, another major bank, so I don't see any issues coming. Hopefully it can keep more people on the Apple devices. I know they had issues with things like MacBooks, but not that this would help with the MacBooks, but in terms of iPhone sales and things like that, I think this is more encouraging, and not even for more sales, just to keep people on it and keep your revenues up and subscriptions. Another one I wanted to go through, as someone who does invest in banks, I am invested in JPMorgan. They did release their earnings. You can see it is up today, which has been quite good for me because I was someone that bought quite high. So around this time I was buying in just because I wanted to add another position to my portfolio. I kind of wanted to diversify. You can see I'm very heavy into tech. I used to be a lot heavier into tech, and I kind of wanted to put a bit of money into a financial sector, decent dividend, strong company. But yeah, you can see JPMorgan still hasn't quite been able to get to those times it was getting around 2021, 2022 early, but it is going back up, and they did release their earnings. They actually did really, really well. JPMorgan posted a record revenue on high interest rates. Shares jumped 7%, as you can see. Quick summary, adjusted earnings of $4.32 compared to the $3.41 estimated, which is huge. A revenue of $39.34 billion versus the $36.19 billion expected. The bank also boosted a key piece of its guidance. Net interest income will be about $81 billion this year, and about $7 billion more than the previous forecast, which is huge. Anyone who's invested is happy. You can kind of see, like I said, that 7% jump. I mean, you look at the last month, just look at that jump in the last week as soon as that earnings came out. And yeah, if you maybe had this expected and you bought into the stock before the earnings, you're probably more than happy with that 10% jump. But yeah, it's helped me get back into the green with this position. And again, it's a long-term position, so I'm not too worried about it. But yeah, it's massive. It is a bit of a controversial one. You see people struggling at the moment with cost of living, and then you see a bank destroy on earnings and post these massive profits. So you see it in Australia as well. You see it all around the world. I mean, even you look at the Vanguard Large Company Index. I'll quickly show you this. Pretty much is made up of all the major banks in Australia. That's one of the reasons I hold it. You can see, here we go, Commonwealth, Westpac, National Bank, ANZ, Macquarie, all are major players in this, and I expect to see the same thing. And though interest rates do make it hard for lots of people, it is a time where banks can post a profit through it. Yeah, obviously your interest payments on your mortgage go up, loans, everything like that is going to be more expensive, and it makes it hard for the everyday person. But just from a shareholder's perspective, it does help kind of bolster the bank a little bit, hopefully to kind of secure some funds. You did see a lot of stuff going on with the banks, with Silicon Valley Bank, First Republic, Credit Suisse, but one of the reasons I am still in JPMorgan is because it's you'd say it's almost in that too big to fail basket. I know it sounds like something they'd say in 2008, but it is a massive bank, and the way it's set up in America, you would have seen a lot of the discussion around regional banks, and people kind of saying, why would I hold my money in a regional bank when I could just move it to one of your big players like a JPMorgan or even Bank of America or Goldman Sachs, where you know your money's secure. And yeah, JPMorgan I don't see going anywhere. It is an international bank basically, all around the world, biggest by assets in America. And yeah, speaking of banks, Bank of America shares also gain after first quarter results top expectations on higher rates. So I'm sure Warren Buffett is happy. Bank of America also reported their earnings of 94 cents per share versus the 82 cents per share expected, and revenues of 26.39 billion versus the 25.13 billion expected. Yeah, the stock rose. Similar thing with JPMorgan. People struggling, but the banks are doing good. You can see stuff from their loans, from mortgages. The banks are always they're filled with smart people. They're going to invest. They're going to have this money in places. They're going to charge customers a lot. Again, they're in the business at the end of the day. That is what they're there to do. And while we're on the topics, it's Goldman Sachs as well, who have their earnings coming up. And if you look at the results of the other banks, you'd expect Goldman Sachs to have a positive earnings report. Bit of a mixed bag going into it before, but they said, yeah, Wall Street expects earnings of $8.10 per share, 25% lower than the year earlier, and a fall in revenue as well. Again, when you see how the other banks performed compared to their expectations, you could potentially see Goldman Sachs having a good earnings report, even with it being unexpected. So if you would go to gold, I was actually someone who has owned this bank before. I did own it. I sold out for a bit of a profit because I didn't think the price was justified. But yeah, you look, gone up in the last month, positive last week. People don't seem too fearful around the upcoming earnings. But again, tough year for the bank, down overall in the last year, tough year for investors. And yeah, it'll be interesting to see how that plays out. I'm not a shareholder, so it's not something I'm too worried about. JPMorgan was one I looked at, but yeah, Bank of America and Goldman Sachs are not positions I own. But it's always good to keep your eyes out and see kind of like the whole effect, the whole macro effect for how things are going around the world. Yeah, in regards to my portfolio, I will be investing a little bit more money in again. I'll probably just be buying into VOO again. I'm getting very close to being in the green. So that's kind of the big goal, is to get this one up. You can see it's sitting at just over 6,000. The goal is to get this over 7,000 before the end of the year. So more I can chip away now while it's technically in the negative compared to the price I've bought in at, the better. And in regards with my Vanguard account, yeah, not much is going to change either. I'll probably invest another few $100, $500 or so this week, and probably purchase into BLC. So that's kind of how I'm breaking down my portfolio at the moment. In regards with any transactions, haven't really had any dividends come in yet. Still waiting for these dividends to settle from my Vanguard account, but yeah, the portfolio stayed pretty similar. That's just kind of an update. I wanted to go through how Netflix was reporting, Apple's new savings account, and then the whole situation with the new banks and their reportings. That is all for now, and cheers.